Hello, and welcome to this webinar. I hope you can all hear me now. And welcome to EDHEC Business School on a beautiful sunny day, sunny afternoon in Singapore. Today, I'm going to present to you the Q1 2021 index release of the EDHECInfra Indices, and also our new asset valuation metrics and some interesting new style indices as well. So a lot of exciting stuff to get through. So let me get started. I will be your host today. I guess I will not introduce myself in too much detail, but I started EDHECInfra a few years ago, and we now turned this organization into a provider of indices at EDHEC Business School. We are, of course, still a research center, but we are now a provider of benchmarks, valuation data, risk data, etc., to a lot of investors. And today I have a lot of new data to show you. Just the usual housekeeping points. I'll try and keep my talk to half an hour and then leave you some time for questions. And we will have the customary poll as well. Okay, so let me start with this new index release for the end of March 2021 with a particular question this time, one that's in the air, which is what about inflation risk, and perhaps more importantly, what about interest rate risk within infrastructure investment? Okay, so this is the picture this quarter. A couple of things to notice. So we have this is the Infrastructure 300 index in local currency returns. As you can see, we still have our customary long-range double-digit returns, which may or may not return. And in recent years and months, lower returns, much lower returns. In particular, in the past year, because of COVID, the Infrastructure 300, which includes a lot of large corporates, airports, ports, roads, etc., has been impacted by COVID-19 and the lockdowns that have impacted some sectors in the infrastructure space. So if you look at the chart, really, the index at the moment peaked at the end of 2019 and has been decreasing somewhat ever since. Not every quarter, not every month, but it's been decreasing. What's interesting is that before COVID hit in Q1 of 2020, the Infrastructure 300, in fact, many of these indices were already going down, and that was because interest rates were up in Q4 of 2019. Well, this is happening again this quarter. So this quarter we have minus 3.9% total return for the Infrastructure 300. And something to notice, which I will return to, which is that we are now computing also this index on a monthly basis. And so you see that in this last month, in March, to the end of March, we also have a negative return. And this is due primarily to the increase in interest rates, which are impacting on a fair value basis these long-term, long-range investments a lot. So if we look a little bit more at the granularity of these results and the details, the usual picture emerges, which is that infrastructure is actually quite varied in its exposure to different risks. So we have across the board negative returns in Q1 2021. That's because, again, of rates. There's nothing you can do about it, you might say. The duration is a bit variable. The impact of other factors on risk premia, and obviously the impact of, for example, COVID on cash flows may vary a lot, but all these assets are impacted by higher rates, especially because rates have been increasing in all markets. So for all different segments, we see a negative quarterly return this quarter. But on a year-on-year basis, we see that not every segment has had negative return. In fact, the most protected would be, as usual, again, contracted projects or contracted infrastructure, 2.2% return on the year, and infrastructure projects, which tend to be contracted. Likewise, contracted infrastructure tend to be projects, 1% on the year. So fairly low returns, again, due to the recent developments, including in terms of increase in the risk premia, which I'll return to. but not negative, which is a lot better than you can say for some of these other sectors. Obviously, on a more medium range horizon, 5 years, we still have roughly what we expect in these sectors in the range of 5 to 8% return. Okay. Let me now go to a different view, because this is all realized. What do we see in terms of expected returns? So at this point in time, what we see in terms of required return, so effectively in terms of market discount rates in these sectors. And here we see something interesting, because for many years now, for about a decade, we've had trending down discount rates, higher valuations, which really came to a bit of a halt around 2017. And then there's a sort of plateau in the evolution of market discount rates for unlisted infrastructure. And after that, sort of inching up a little bit as interest rates continue to decrease. But this year and this quarter in particular, we see for the first time in a while an increase in not only rates but also premium. And so expected returns are on the way up, particularly notable in the merchant road space, for example, where we're now above 10%, and the broad market, which is return above 8%, which is quite something, because it hadn't been there for quite a while. Now, one question that keeps returning in recent months has been this question of inflation, and whether inflation was a problem for investors, in particular, whether infrastructure was immune to higher inflation. So this is something that's worth digging into a little bit, especially because, of course, expected inflation is related to the recent rise in interest rates. So what do we know about infrastructure and inflation? If we look at the business model of various infrastructure companies, we see that some have an inflation pass-through. They have a contract which says so, that their tariffs or whatever rents they're being paid will be indexed on inflation. Some have their tariffs indexed on inflation in a partial way, typically utilities, which can have an inflation pass-through, but usually is a partial one, because they're also expected to become more efficient, for example. So this is the classic RPI minus X formula, for example, which is a bit of a catch-all, but there's an X in the formula, right? So you don't just get RPI, you get RPI minus something. So it's not a full pass-through. And then, of course, you also have infrastructure companies that basically don't have inflation pass-through in their revenues at all. And so at best, I guess, if you look at a broad portfolio of infrastructure, you are likely to have a partial or an imperfectly correlated with inflation set of future revenues. The other thing that is a bit tricky is that the revenues may be indexed on inflation, but it doesn't mean that the dividends are indexed on inflation. Because once the cash flow waterfall follows its path, and you have OPEX and CAPEX and debt service, etc., you end up with a stream of future dividends, which is a lot less related with, a lot less correlated with revenue, right? And therefore a lot less correlated with inflation, if revenues were correlated with inflation to begin with. So we're going to have this imperfect correlation with the dividend stream, quite imperfect, in fact, pretty low, and inflation. On the other hand, the values, of course, change with, in a discounted cash flow framework, they change with a combination of risk-free rate and premium. And here we have a much stronger correlation with inflation, because usually, in general, if inflation increases, the interest rates will as well. So the risk-free rate component of the discount rate will go up. So this is almost perfectly correlated with inflation. And to the extent that the risk premia is a function of the term spread, which we use to model the risk premia, so the difference between long-term and short-term rates, the higher rates, especially higher long-term rates in some countries, might increase the slope of the term structure and also increase the risk premium. So inflation, meaning a change in the term structure of interest rates, has a stronger impact on the discount rates than it does on dividends. So probably we're going to see some impact of inflation indirectly through interest rates on value, some negative impact. So this is where the duration, the sensitivity to changes in the discount rate of infrastructure companies become important, and where inflation becomes something to watch out as an investor in infrastructure, because you're discounting not a few years of cash flows, but many decades of cash flows. And so the changes in discount rates can have a large impact. So in this quarter, we can break it down this way. In fact, this is quite a neat way to understand this effect. We've had evolution in this quarter of all the three components of the DCF formula. We've had a change in dividends, in this case a negative one, again, because in aggregate we have some sectors where dividends have been revised down, again, airports and some other transport sectors. And so we have an aggregate change in revenue of minus 0.7% for all the assets, right? And over the entire life of these assets, the amount of dollars, if you want, that before it's discounted this quarter is down by 0.7%. So that's not a lot. In terms of revenues, this has an impact on dividends, which is even smaller. So an even smaller impact of 0.1% in aggregate on the NAV, right? So the amount of dividend that is going to be discounted is almost the same than last quarter, but a little bit smaller. And that's because, even with COVID, even with lockdowns, and in some cases recessions, there's many years of cash flows in infrastructure to discount. And so having lost maybe a few years or a couple of years of dividends doesn't actually decrease this total sum of these dividends by that much. What makes a big difference are the other lines here. So you see that in this universe of about 530 assets, which are live today, you have a duration of 8 years. So sensitivity of interest rate or discount rate changes of about 8%, meaning that 1% change in interest rate, 100 basis point change in interest rates leads to a 800 basis point change in value. And so this quarter, we had a 0.5% aggregate change in the level of risk-free rates. That's aggregate across the yield curve and across 25 countries, right? So it's quite varied across the different assets, but that's the aggregate effect. And in aggregate, this has a negative minus 4.1 impact on net asset value. And that's without changing the other, that's the pure effect of risk-free rates, without changing the other parameters. Likewise, we see a small increase in the risk premium of 20 bips. That's because in some sectors, we see a higher risk premium. Again, in part because of higher interest rates. And this has also a negative impact on valuation, a minus 0.2 aggregate impact on the NAV of the entire universe. So in aggregate, all these things taken together, less dividends, higher interest rates, higher premium, decreases the NAV of the entire, the aggregate NAV of the universe by minus 5.2%. And so if you're trying to relate this with what I was showing you before, I was showing you a quarterly return of minus 3.13 for the broad market on the previous, one of the previous slides, which is here. Okay, minus 3.1 is 13 on the first line, broad market index. Now, if I tell you that the cash yield, which is positive, is the quarterly cash yield is about 2%, which is roughly 8% annualized. Well, you got, plus 2, minus 5, you get minus 3. Okay, so that's roughly what's happening in terms of total returns in aggregate across the sector this quarter. And if you want to go more into a little bit into the details of this argument on inflation and the relationship between inflation and interest rates, we have a piece in the FT this week, last week. So I invite you to have a look at it. It delves a little bit more into this argument, and in particular the role of interest rates. Another thing I wanted to highlight, since in this quarter we're releasing some new tools, is that we now have in our platform a little gizmo like this, a little set of analytics, which allows you for different segments to see this decomposition of change in NAV over the past 6 quarters or the past 5 years. in terms of these three components. So what I was just explaining, but in a nice and kind of colorful format. So you can pick a segment and see what the impact of change in interest rates or change in risk premia or change in cash flows is on the valuation. Right, a word about debt. This quarter, well, guess what? Debt is also in negative territory. If you look at bonds, see somebody put a little post-it on my slide. The corporate bond segment in the sector is also very negative this quarter, -5% for the S&P International Corporate Bond Index. And so infrastructure is not doing too badly in this respect. We have a broad market private debt index for infrastructure, which is about 1,000 instruments, and it has a negative 2.1% quarterly return this quarter. It otherwise is in good shape in terms of, so it all depends on what happens with the rates later, but it's in good shape in terms of its more recent performance. And if you look at the table underneath, you see that this entire change, this entire negative return is driven by higher interest rates, because the spreads have basically remained constant between Q4 of 2020 and Q1 of 2021. On average, we have about 150 bips in terms of credit spreads across the entire debt universe. That's both loans and corporate bonds, all in private infrastructure debt. But the yield, as you can see, is higher by 40 basis points. Okay. All right. Let me now go a little bit more into the details, because it's important for us to highlight the precision of the results that we're computing in order for this information to be of the most use to investors. So I'm going to delve a little bit more. I sometimes do this in these webinars, but today I'm going to delve a bit more into how precise these valuation models actually are, because they're quite precise, and it's actually a good thing to highlight. Just as a reminder, for those of you who don't follow these webinars regularly, how do we measure the fair value of unlisted infrastructure assets? Basically, how do we have all these numbers I was just showing you? Because obviously we cannot use what you would do in, we can use comparables, or we're going to do what you would do in real estate or sometimes in PE, by which you would find a number of equivalent transactions, and you could look at your EV to EBITDA or your price to book or whatever, and say, okay, well, for this deal, we can come up with a reasonable estimate of the market price. Here, it's impossible. There aren't enough deals. There are probably not enough assets in the world to do this. And of course, they trade very, very irregularly. So let's focus on the heart of the question, which is the price of risk. Let's say we have some cash flow data. I think we'll do another webinar a bit later this year on the cash flows and cash flow forecasting. But let's say we have some cash flow data, maybe your own cash flow data, for example, the asset owner's cash flow data. We have some interest rate data that's fairly easy to get. You can get it from your Bloomberg terminal and then build your yield curve. The key here, the name of the game, is to find the risk premium. So how are we going to do this? Well, luckily, we can still observe some transactions, right? So every quarter, every month, there's some infrastructure companies that are sold in the secondary market. And so if we can observe these, and we can, to a certain level of detail, and we can understand the expected return, so effectively the IRR of each transaction, we can then try and decompose this IRR, this risk premium, into a bunch of factors, right? So we're going to say that all of these deals, all of these companies that sell on a regular basis on the secondary market, and asset level, not fund level transactions, they're all exposed to the same factors. They're all exposed to a size factor, for example. They're all exposed to a leverage factor. They're all exposed to a profit factor, etc. So there's a bunch of factors like this that we've established. And we're going to call these factors, or the exposure to these factors, beta. So if you have a lot of leverage, your beta is your leverage ratio, right? And if you're very big, your beta, your size beta is your size, total assets, etc. Now we can find the price of these betas, the price of these risk factors, as the time passes, by observing these deals and decomposing the risk premia into the price of these risks, which we call lambda, which is basically the premia, right? The market price of each one of these risks. And having established this, we have an estimate over time of the price of each risk. And therefore, when we need to price to value another company as one that hasn't been trading recently, we don't need to find a comparator. All we need to do is multiply its betas, its size, its leverage, etc., by these risk prices, by these risk premia, in order to get the market calibrated, because it's the latest quarter, risk premia for that company. Right, so it's actually quite simple. You just need to do a little bit of econometrics to get these numbers. This isn't something we're going to get into today because that's a little bit too technical. But suffice to say that with the right model, with the right technological or econometric approach, you can extract this information from the data. And I'll show you that you can extract it in a way that really works. So first, what is the data that goes into these models? So I was telling you that we were observing deals and extracting the risk premia from these deals. So what are these deals? So here I'm showing you the distribution of the price information that goes into these models. This model is only one model. Here you see two charts with 3 columns. So the one on the left is the split by sector of these transactions. The point here is to show you that we have transactions across the board in many different sectors. And then we have a test data set, which is the companies that we're going to price and that actually are in our indices. So we can then compare the valuation that we come up with their market price, how much investors paid for them. And in the third column is the Infrastructure 300, which is an index built to be representative of the underlying investable market in 25 countries. So what's interesting here, perhaps it's not a big surprise because we've been collecting this data in all these markets, there's a reasonable match, right? So we have this calibration data set, which is about 1,000 deals. This is how we calibrate the model, how we find these risk prices. We have this test data set, which we're going to use to to price companies, actual companies, and see how they relate to the actual price that was paid. And then we see that this amount of information is roughly in line with the distribution of deals available or investments available in the world anyway, right? On the second chart, you see that this is also true in terms of business risks. So we have roughly as many observations in terms of contracted, merchant, and regulated than we have in our test data set, and then we also have it in the world. I could also show you the same data by corporate versus projects, so corporate standard corporates versus project finance, where it's very aligned, and also by geography, where again, as we often highlight, most of our data comes from Europe and Australia, but so does the universe that tracks the Infrastructure 300. So it's perfectly aligned if you want. We have observed enough prices in enough countries and enough sectors of enough types of infrastructure to cover the market that we're trying to cover, which is these 25 countries that make our universe. Okay, so that's the inputs, right? That's all the money, not the money, that's all the information that goes into this model. What do we get out of it? So here I'm showing you the marginal contribution of each one of those factors to the risk premium. So how does that work? So on the left, you have leverage, for example. So to be clear, and in fact, this one is nice because it's simple. The average leverage factor loading, in other words, the average level of leverage in this universe, global universe, is about 75, 78% over the past 20 years, and it's pretty much constant. It's always the same in aggregate. So the beta, right, the average loading in this universe is roughly constant. But this is the impact of the factor, the beta, times the price, right? So here what you see is the marginal contribution of this leverage factor, the price of leverage times the beta, to the premia, to the risk premia. And you can see that obviously it's been decreasing a lot over time, which is not a surprise. We know that yields have decreased a lot. But here you see that they've decreased a lot because the price of the leverage factor in particular has considerably decreased. It has basically been halved since 2010. You can also see that this leverage premia goes up in bad times. So it goes up in 2001, 2002. It goes up during the GFC. It goes up during the Euro crisis, Euro debt crisis. It goes up recently during COVID. So in these periods, we have higher premia because it's a bad time. And so the same leverage is more costly, right? It has a higher premium. And obviously the value of the same companies is lower. The other thing that's interesting is that you have these three lines, one which is for the low leverage companies. These are companies that have less than 70% leverage, medium and high. And you can see here that obviously the more leverage you have, the higher the premium, the higher the effect. But there's also an interesting thing, which is that the purple and blue lines are very close. And that's because there comes to a point in infrastructure investment when you start adding more leverage. So basically when you go from 75 to 80%, meaning you're going towards these very robust contracted PFI, renewable energy, long-term contracted projects, more leverage is actually not a sign of higher risk, because the reason why you're adding more leverage, and this is the magic or the art of project finance, you're adding more leverage because the cash flows are very secure, right? So like adding more leverage increases the premium, but up to a point, and then beyond that point, it doesn't, which is the difference between that pink line and that blue line. Let me not get too much into the details of project finance, but just look at the second one on the right, which is the investment factor. It's basically CapEx divided by total assets. What this shows you is that in assets that have, or companies that have high CapEx to total assets, so basically assets that come out in greenfield stage, have a higher premium, because that's a period that's riskier. You're sinking a lot of capital and you're not sure what's going to happen next. And that those that have very low CapEx to total assets has almost zero effect on their premium, right? So you have this initial higher premium during the development phase, the construction phase, and the greenfield phase, and then it goes away. And this has also been decreasing over time, but a lot less dramatically. So the price of the greenfield effect, if you want, is still hasn't been decreasing as fast as the price of leverage. Okay, I'm just going to show you these two factors, because there are many others. There's 5 key factors in our model, and then there's some control variables. The point is that the combination of all these factors, which are all independent, and as you can see, they don't move at all together, gives us the risk premium. So once I have the betas, I have the exposure to each risk factor of each company, and I have this price of risk, I can compute a risk premium for any company, and I can compute it for each company. So they're all different. Here, what you see is the average across the infrastructure 300 index. You have the average risk premium in pink. And then for each one of those companies, we will add it to the term structure of interest rates at that point in time in that country, and that will give us a discount rate. And the average discount rate is the blue line. And here you see again what we've been talking about before, the decrease in yield, the compression of yield, but the sort of plateauing of risk premium and eventually of yield around 2016-17. And eventually, especially in the last quarter, despite the ever so slightly higher premium, a much higher discount rate, because interest rates are increasing again. And basically every time you have a peak, it's because either the premium, if you can see the pink line, but also interest rates are going up. So this has the effect of in affecting the valuation negatively, and vice versa when it goes down, obviously. So now that I have discount rates for each company, I can price them, right? So this is one case. There are many cases because we track several hundred. This is one wind farm in Ireland, which was sold in 2018. It's just an illustration, but as you can see, we have on the left-hand side in the table, you have these factor loadings, right? This company has actually a lot of leverage, a certain size, et cetera, et cetera. We arrive at a risk premium, which you might think is quite high for a wind farm, But if you look at the investment factor, it's 38%, meaning that this wind farm is still in full kind of development mode, a lot of capex, which has the effect of increasing the risk premium and the discount rate. As you can see, if you look at the second column, the sector average, the risk premium is much lower at 5%. Right? And so using this discount rate and using the cash flows, the future cash flows for this asset, the dividends that are represented on the right, you get a price, right? So we compute this price, and this is one of the 250 that I'm comparing in my model with actual deals, because here I have the price. And as you can see, we get pretty close, right? We get within 5%, in fact, in this case, 3% of the price that is being paid. And in terms of ratios as well, it's very close, of course. If the price is correct, then all the ratios are very close as well. Okay, so this to show you an example of how applying this methodology, you capture the price of risk at each point in time, and you're able to produce valuations that are very close to actual market prices. Now that's one case, but what about all the other cases? So here I'm showing you the average for all these deals, right? For these 250 test assets. And as you can see, the performance is also very strong, right? So on that picture, you have the EV to EBITDA of the companies that we observe. This is the EV to EBITDA at the moment of the deal based on the price that was paid, that was reported. And on the horizontal, vertical axis, or you have the one we predicted. So as you can see, they're all very close because they're all very close to that line, even though the scale is huge, right? So actually, they're not all exactly on the line, of course, but they're quite close. And the fit between the predicted values and the reported values is also very good. What that means is that we can't predict the exact price because we don't have a crystal ball, and every deal will include some component which is not driven by market forces, you might say, but it's just the result of the individual investor, right? Maybe some investors are more risk averse. Maybe some investors are more risk loving. And so they're willing to pay more. Maybe they do, they get a great deal on one day, and so they pay less, etc. So pay less than what the average market price would have been. But on average, we should be predicting something that is what the market price tends to be. So here, on average, we're very close. I see the median and the mean errors are very close to zero. But of course, there's some dispersion around this because, once again, investors do not necessarily pay exactly the average market price that is predicted by systematic risk factors. They have other reasons to pay more or to pay less. Most of the time, however, this is something that's pretty consistent. So that goes to show, one, that this is a market with systematic pricing going on, just like any other market. Therefore, that you can predict valuations based on systematic risk factors. It also means you can benchmark returns, by the way, because there's a little bit of idiosyncrasy going on, but most of the aspects that are driving value and therefore returns are systematic, just like, again, for every other market. So that brings me to, so these models work very well, and that brings me to these valuation metrics. We're launching something that I meant to highlight. So if you go to the EDHECinfra platform since the past couple of days, you can see something new. You can see a little window like this with a new block called asset valuation. So let me try and show you what that looks like. If I can. There you go. So if you log in, the usual login in our platform, you have the indices in that box on the left. That's the usual thing, and then asset valuation in the middle. And what that tells you, so this is the difference between this approach and the indices, is that this is all about cross-sectionality. The indices are about time series, right? We show you over time, the change in value, over time, the returns, etc., of different segments of the universe. Here, this is all about how things differ now, or let's say in recent history. So either the last 5 years in this case, or the last 6 quarters, if you want to be even closer to recent changes. And so here, for instance, for global infrastructure, you see the distribution of EV to EBITDA across the entire universe, right? You have a a range between 3.4 and 26.9, with a mean of 12.6 and a median here 50% of 12. And I can change this for an absolute presentation so you can see the nice kind of quarterized distribution. But this is actually, of course, more representative of the distribution of the data when you look at it on an absolute basis. So, of course, this exists for the global infrastructure, but we can also pull this information for, say, the transport sector and compare it. And each time we have a selection of countries, we have a selection of sectors, of subsectors for each segment. We also have, obviously, our usual contracted or merchant or regulated segments, etc. So we have these ratios basically for different types of investments. And interesting new thing, we have core and core plus, value add, and mid-market. So I'll return to this later. But this is also a new thing in our system. And of course, apart from these ratios, we have expected returns. So we can basically present the same information I just showed you, but by segment and in terms of distribution. So again, in a cross-sectionality sort of approach, the risk premia in particular, it's in different segments. We can compute the cost of capital, including obviously the WACC and the combination of cost of equity and cost of debt, because that's we also compute the returns on debt. That's the app I was telling you about earlier, which shows you the decomposition of the various effects of cash flows, risk premia, and dividends on the NAV in aggregate over the past 5, 3, and 1 year, etc. We also have a bunch of debt metrics, which are quite good. In particular, yield to maturity for different types of debt, investment grade debt, which we segment using our own credit risk model, fixed rate debt and floating rate debt, credit spreads also are, you can compare credit spreads in the different segments, and of course the different types of debt, etc. And there'll be a couple more things that we're going to release in a week or so, in particular to do some cash flow benchmarking. Okay. So let me stop this and go back to this, to my presentation. Just to summarize, yeah, so we're going to have basically what I just showed you. Also some risk-free rate data in this cash flow benchmarking, and all our credit risk metrics as well. So this will be released in the next couple of weeks. But at the moment, you have all this new stuff to play with. All right, so we have these new valuation metrics, which I guess are a nice output of this valuation model I was describing. The other thing that we've started doing are new indices, because as you know, if you're familiar with our work, we've presented everything in terms of TICCS. TICCS, the Infrastructure Company Classification Standard, is a way of segmenting the universe, which is easy and quite objective. And it's been used by a lot of clients to map their portfolio effectively and try and build a customized benchmark, for example, for them. But we still have a lot of demand for other things. And so we've decided to create some style indices as well, just to reflect maybe something that's a bit more, has to be well defined as well, but a bit more hybrid, if you want, than just individual segments like contracted or regulated or projects, etc. All right. So the first thing we've done is look at core and core plus. That was something that was in great demand. And I mean, you might say, how can we define core and core plus? I thought the whole point of core and core plus is that there is no definition and no one agrees on what it is, or no one wants to agree on what it is. So we decided, okay, well, we need to define it. So we did. We considered that at the heart, core, core plus, value add, all this terminology, which comes from real estate really, is about risk appetite. Therefore, it's about expected returns, right? And expected returns means discount rates. So what we did is segment the universe by expected returns, by discount rate, and build indices based on that, right? So if you have here on the picture at the top, the density or the distribution of discount rates in the cross section, okay? So it's a density plot, so it's kind of smoothed. So don't worry, it doesn't go below 0, but it goes basically from 0 to 30%. And we've decided to take the first two, actually I didn't write this on the slide, but the first two quartiles are core, right? So that's the gray area. The third quartile is core plus, and the rest is value add. So we have these three well-defined buckets of expected returns. The first one is basically half of expected returns. And then there are core plus and then value add. And that's what you get. I think my picture is wrong. The gray area with core should go all the way to the second line, which goes in the middle of core plus. And core plus should only be between the the second line and the third line, because that's the third quartile. Sorry, so the little colors are messed up, but you get the idea. Core is all the way to 10%, basically. Core and core plus, so core plus is from 10 to, let's say, 14, 13.5, and then beyond, above 13.5, it's value add. The colors got a bit messed up. And so if you look at these indices compared to, which is in the table below, compared to the global broad market index, you see a familiar picture. In fact, you see that core has lower risk and lower returns, and also suffered less in the recent quarter, in particular because it has lower duration. So less exposed to interest rate risk. And core plus does. And if you went to value add, it would be even more obvious. So this is something that might be useful to look at infrastructure from a different angle than the ones we've been proposing so far. Moving on, I have another new thing, which is computing indices on a monthly basis. So far we've been producing quarterly indices. That's because the data is fundamentally available, new data is fundamentally available every quarter. But we've had very strong demand to produce more frequent valuations. Client reporting for some managers, risk reporting for a number of insurance companies, regulation requires them to report on a monthly basis. So the thing is, we could do this because of our approach. We could run our model more frequently. In fact, we could run our model every day if we wanted. That would be a bit much, but we can certainly do it once a month. However, the price data doesn't arrive faster, right? So what we do is that we have these risk premia that we compute once a quarter, we estimate once a quarter. Between 2 quarter points, we're going to interpolate the risk premia, because that's the best guess, basically, that we have. But we will update the term structure of interest rates at each end of month date. So that will mean that we'll be able to capture even better the impact of interest rate risk on infrastructure, which is our topic today. And I think will be a topic to visit again, because it's really an important aspect of infrastructure investment. And so, in fact, one good reason to do this monthly computation, not just reporting, but because it allows us to better understand interest rate risk and the role of infrastructure, for example, as a liability hedging instrument correlated with interest rates. So this is an example of I'm building two things into one here, of a new theme and a monthly index. A new theme is this Infra Green Index that we're also launching. So we do still have a renewables index, but this is defined in a more, let's say, engineering sort of approach, meaning that it includes hydro. And so that you have a mix of corporates and projects. Hydro companies tend to be in different countries than where you have wind farms and solar farms, etc. So it's a mix of renewable energy projects and investments, but it's not necessarily the most, so let's say, what people have in mind today when they say are investing in renewable energy, which is wind and solar. So we decided to make this index with just wind and solar, which has about 90 assets today. I think over the past 10 years, it has about 100 in it, but some of them fall off the index because they don't survive. It's mostly in Europe and a little bit in Australia and the Americas. So here you can see this index compared to the infrastructure 300 index. One interesting characteristic, but of course this is a function of it being a project contracted index, or an index of project contracted assets, is that it has a better risk-adjusted performance. It suffers less in recent times, and it has also less duration than the lower duration than the broad market, and therefore, even in this quarter, has positive returns, which in this month, in March, because this is monthly computed, has positive returns. So this is a new one that I think quite a few people are going to want to try. Okay, now the time has come for my favorite moment, which is the poll. So I'm going to ask you these two questions. First, we talked about initially whether infrastructure is an inflation hedge, so I'd like to hear your opinion. And then I would like to ask you what you think about using interest rates, market interest rates, or the latest interest rates, in the valuation of long-term assets like infrastructure. Obviously, this is what is required by IFRS 13. If you're doing this properly, you have to use the latest market input to calibrate your valuation. But not everyone sees it this way. So I have this question as well for the audience. So let me start with the first one, which I think you should be in a position to answer now. I hope this is working. We're using a new system here, and so I'm not sure that you can actually do this. Can someone confirm to me that that they can answer the poll in the chat, please? Okay, good. Okay, so this is the first one. I hope you've, it doesn't tell me how many people have answered, so I think I prefer Zoom. So that was the first one. And then I'm going to push the second one. Let's see what you think. Is it better to use market interest rates, or should you just not and keep your interest rate constant and have a slightly smoother valuation? I'm going to let you answer that one, and then we'll look at the results. Oh, actually, it does say at the bottom how many people answered. Okay, not too many of you. Come on, make a little effort. There you go. A bit more. No, we're getting there, 40% of you have answered the question. 50%. Now that I've found a way to see how many people have answered, I might go back to the first one and ask you to answer it again. Okay, 60% have answered. That's good. One more, please. That would be exactly 60%. That's good. And then if we look at the first one. Oh, okay. Well, let's see. Okay, so now I'm just going to show you the results for the first one. So most of you think that infrastructure is an inflation hedge. Okay, that's interesting. I mean, it is something of an empirical question. In fact, something we want to look at more closely in our own research. But obviously, my main concern is that the correlation of future dividends with inflation is not as strong as the correlation of the discount rate with interest rates, which is correlated with inflation. So this might be a concern, but there you go. And now to the second question. Okay. Most of you think that IFRS 13 is the way to go. I would agree there. But it could sometimes be more useful to look only at the risk premium. And that's the case. So if you're looking at these things from a portfolio perspective or risk management perspective, I think the first answer is the right one. At least I think your regulator would agree. But if you're looking at investment, individual investments, or you're comparing investments, then risk premium is really where this is at. So this is an equally valid perspective depending on what you're trying to do. And then we still have a few people who basically would rather not use market rates for infrastructure investment. Okay, so that's pretty much it. And just have one last thing to show you, which is our plan. So I've shown you a few new things. We're putting out these market valuation metrics. We're producing these new indices, computing monthly indices. The other thing I wanted to show you was that we have some more plans this year to develop products. We are working on a fund benchmarking tool, which would use the same asset pricing technology to show the performance of typical funds, right? Which we can reproduce, because then once you have all the prices, all you need is a bunch of assumptions about what type of fund you want, and then we can look at all the different quartiles and performance of these funds for each vintage, etc., each style, etc. Another thing we have in mind is to develop a position keeping tool. So if we can do valuation and we can also provide our clients with valuation metrics, we could also actually build a tool that would exploit this factor model to produce valuations directly online. So that's something that we have in mind to develop later this year. And finally, asset rating is something that we're looking at as well, because this would be a way to aggregate the information that we have, that we produce, which can be quite rich, but also difficult to compare across the board or to aggregate. To build these asset ratings would allow to make comparisons more easily across assets and also across portfolios, right? So if these are things that interest you, I think, in fact, I encourage you to let us know, send us an email, and let us know which one you would like to see, maybe or other things, and we'll be happy to discuss this with you. That's the email here, and of course you can always check out our platform and see what the stuff I just showed you. Right, I'm now going to turn to questions. So let me see what questions we have. Once again, I'm struggling a little bit with this new interface, but how can one get more information on the Infra Green Index? Well, send us an email and we'll send you more information. That was from Martin. It's brand new, huh? So it's in the system today already, but if you want more information, we can provide that very easily. Will the slides be available? Yes, we will send them out a bit later, probably tomorrow. Okay, then we have a few people saying, yes, it works, thank you. Do you have a specific analysis for junior debt versus senior debt? Okay, that's from Hervé. So we only track senior debt. We only track senior loans, senior bonds. We don't look at, I mean, we have information on MEZ and the detailed information of each company, but we don't have a MEZ index or a MEZ analysis or anything like that. We treat, however, speaking of junior debt, we treat all subordinated loans, all shareholder loans as equity, right? Because that's effectively what it is. So in the equity bit, we have all the shareholder instruments. Can you please elaborate why listed infrastructure was not hit by rising rates in Q1? The MSCI World Infrastructure is up. Okay. That's because, interesting question. It has to do, for the most part, with the fact that the MSCI World Infrastructure Index has very little infrastructure in it, or only one type of infrastructure, and a lot of other things that may not be that infrastructure. I mean, they're infrastructure-y, but then it's not infrastructure projects or very well-defined infrastructure corporates. And it's listed, so you have a market beta in there, which is giving most of the return. So if you look at these indices, this one or other ones, they're basically perfectly correlated with the market, the broad market index. So the MSCI listed infrastructure index will be, I'm going to guess, have a beta of 1 with the MSCI World. So it's a broader question. Why was the MSCI World not hit by higher interest rates in? And that's because everybody got out of bonds and went back to the stock market. So in fact, we are approaching infrastructure more like a bond, you could say, which it is. It's in between, right? But we're treating infrastructure as a stream of future cash flow, which you have to discount as a function of the risk of these cash flows and their duration. And so it's something that I think is the most adequate way to look at infrastructure. But yes, you're right that it doesn't have to correlate very strongly with stock markets, especially even though it's called infrastructure, with indices that are basically have the same returns or the same beta, or beta 1 for 1 than the world market. I see I have another little question here. Will monthly index computations also be applied to historical index level, or just going forward? At the moment, for the Info 300, it's going forward. But we're planning to look at that because as I know that in some cases, but these are more like custom indices. We've been asked to do this on a monthly basis going back. But at the moment, it's going forward for the Info 300. Okay, I think that's all the questions, and that's all the time we have. So on this, I'm going to thank you very much for joining, and hope you find this interesting. Again, don't hesitate to contact us if you want to know more, and I will finish this, if I can, with a little video.
For investors in private infrastructure, current industrial classifications are not adequate, making it hard to understand performance in a multi-asset class context. Several definitions of infrastructure exist. The OECD and World Bank use definitions based on public policy, while asset managers focus on broad industrial activities as well as core or core plus strategies. For investors, these classifications do not reflect the risk profiles of infrastructure companies. How would you group infrastructure companies to better capture their risk profiles? EDHECinfra has created the Infrastructure Company Classification Standard, or TICCS, to provide a frame of reference for investing in infrastructure assets. Using a multi-criteria, 4-pillar approach, TICCS is designed to be compatible with other standard investment classification schemes, enabling investors to understand infrastructure investments in a multi-asset class context. Business risk classifications highlight the role of different business models and types of regulation. Infra companies are usually understood to be tangible assets, but these investments are better defined by their contractual arrangements. When it comes to business risk, it's contracts, not concrete, that matter. Industrial sector group classifications represent broad areas of industrial activity, but also transaction or project development expertise. Meanwhile, industrial sector and subsector classifications represent specific industrial activities. 4 levels of geo-economic classifications demonstrate whether an asset is exposed to local, national, or global economies. The 4th TICCS pillar reflects the differences in governance between infrastructure projects and corporates, 2 types of firms that are expected to have different risk profiles. With TICCS, investors can use a robust, dynamic, and global classification of private infra companies based on a transparent step-by-step methodology, reflecting common sources of risk found in these businesses. It's available for download on our website.